SEBI has proposed a set of changes with so many algos running, average losses of up to 28 lakhs per person. Primary reason is the evolution of the trading platforms. You need discipline. Very, very risky proposition. Every time we meet our clients or host a client meetup, a number of clients are asking us, what are you doing in the future and options segment? We are really interested in the future and options segment, and how can Right Research help us in that arena? In this video, what I'm going to do is talk about the future and options segment in India. What are the reasons why people are so interested in this segment? And obviously there's a lot that is happening in terms of regulations. SEBI is coming with a number of new rules to sort of regulate this segment heavily. So we'll talk about that. We'll talk about what are the different strategies that people use in the F&O segment. We'll talk a little bit about algo trading. What are the algos people use and what are the best practices for you to use if you are interested in F&O trading. So let's start by talking about some key data points first. The F&O segment in India has seen a remarkable growth. In 2024, Nifty 50 had 1.64 million options active every day. In comparison, S&P 500 only had 1.4 million. You can imagine India, which is a much smaller scale country compared to the US, has more volume in their index options compared to the US. And this is being driven primarily by the resurgence in the retail segment. In 2023, NSE reported around 84 billion contracts being traded on its bourses on the yearly basis. And in the global market itself, 137 billion contracts are traded on a yearly basis. So you can imagine that NSE has a huge portion of the global F&O contracts being traded. And like I said, this growth is driven by retail traders. Right now, if you look at it, retail participation in the F&O segment is 41%. And this is a substantial rise because this was only 2% in 2018. The number of trading accounts in India have in fact increased of 36 million in 2019 to close to 154 million right now. As of February 2024, the total turnover in F&O trading has reached $6 trillion, which is six-fold increase from 2022. So what we will do in this video is we'll answer a few questions to understand this growth. First is, why is this resurgence happening? Why is retail so much interested in F&O? Primary reason for the growth of F&O trading in India, especially among retail, is evolution of the trading platforms. With the proliferation of discount brokers, user-friendly UIs, easy access to APIs, you can see that F&O trading is much more easier today in comparison to what it was a few years ago. Discount brokers, they give you access to F&O trading at a very, very cheap cost, much cheaper than what was available previously, which makes people use these instruments more and more. Here you have your brokers like Zerodha, Upstocks, Angel One, which are discounted, which are driving most of these volumes. Second big reason for this growth is the rise of financial influencers. We can see so many influencers across different channels like YouTube, Twitter, etc. are talking about what they are doing in their F&O trading. They are talking about chart patterns, they are talking about these trades they made, their P&L snapshots they post everywhere, right? Many of these people in fact are not genuine and they would be posting false reports or false screenshots. While there might be a few genuine influencers as well, this is a mixed space. Finally, the economic factors are also at play. With low interest rates and limited opportunities in the traditional market, people are looking at what they can do in the equity markets and the equity linked derivatives. That is driving them towards F&O trading. But yes, there are a lot of risk associated with F&O trading, and SEBI in fact came up with this report which highlighted some very, very glaring facts. There were some key findings which are very alarming. SEBI said that 93% of the retail traders who participate in F&O trading are making a loss. Around 3.5% of the loss makers make the majority of the losses, with average losses of up to 28 lakhs per person. And in fact, profit making is very rare. Only 1% of retail traders make profit, and the average profit is around a lakh. Together, retail traders have lost 1.8 lakh crores in F&O losses. On an average, every trader has paid around 26,000 rupees in the fee that they pay to the brokers, and brokers have made more than 50,000 crores in profits through these trading costs. What we've seen is that young traders have increased significantly and people are not afraid of losses. Despite making continued losses, 75% of the traders still persist. Another alarming thing is that large prop funds and algo trading firms, institutions, especially outside of India, coming as FPIs or Indian prop funds, are making most of the profits. So F&O trading has sort of become a wave through which the profits are going from the retail segment to these large institutions. Obviously, loss making is one part, but second part is that F&O typically is highly leveraged, right? You are betting for 4 times the money that you have, and because of this volatility that happens in the leverage market, it's a inherently very, very risky proposition. So while you might have a good trade in place, while you might have a sound idea in place, sometimes even the operations, you couldn't trade the trade at the right time, can lead to big losses. So it is inherently very high risk. Finally, there's psychological risk to trading as well. Trading is a little bit akin to gambling. You can make 4x profit or 4x loss. People tend to chase their losses. They tend to go into a gambling behavior, which can have significant risk for the retail traders. Now, with the report that SEBI has come up with, where they're seeing that average retail trader is losing a lot, while the FPIs and the large institutions are making a lot of money from this F&O trading, SEBI has proposed a set of changes they want to do in the F&O regulations. The first change that has in fact come up recently is the reduction in expiry days. The one-day expiry contracts have gone away, and the weekly expiries are now limited to only one contract per exchange. Previously, Bank Nifty was also traded on a weekly expiry. Now only Nifty is traded on a weekly expiry, and the BSE only trades Sensex on a weekly expiry. That change has already happened and has actually impacted a lot of traders and their strategies. Second thing that we are hearing is that they want to increase the contract size. So right now the contract size for these instruments is such, the margin required for buying a future is around 2 to 3 lakh per contract. What SEBI is proposing that they will increase this margin requirement to 10-15 lakh so that it suppresses the retail trader from betting using F&O. Finally, what they're saying is there will be upfront premium collection, which means that brokers will have to collect upfront premium so that they can suppress excessive intraday trading. Finally, expiry day is the time when a lot of speculative trading happens. So what they proposed is there will be additional margin that would be required during expiry days. Finally, even on the position limits which are there in the intraday basis, SEBI has proposed that there should be increased monitoring of these position limits so that people are not violating them. Now, how is the retail segment adapting to these changes? Still, like I said, because of these big changes that are happening, many strategies have had to adapt. A lot of expiry day trading strategies have in fact had to change. Similarly, traders are gearing up for change in contract sizes and increased margin requirements, because that will impact a lot of what they do. There's also a lot of noise about people trying to shift to alternative instruments. For example, currency derivatives or forex is something where they might find more volume. Finally, commodity derivatives or forex is where there could be more volume and where they could speculate more. So we are seeing, in fact, even in smaller tier 2, tier 3 cities, people are showing more interest in commodities and forex after these changes. Finally, I think these changes that have happened have also led to people talking a lot about the need for education and people understanding the risk associated with F&O trading, and that is also changing. So let's quickly talk about what are the different trading strategies that people actually use when they are doing F&O trading. I think most of the trading that happens in the F&O space is highly speculative. People try to look at chart patterns, people try to look at technical indicators, and they try to participate in some short-term trend with their F&O positions. Many will see a news anchor talk about a particular stock going up and down, and they might take a positional trade in that contract. People might speculate that the index is going to go up or down, and they could take speculative position using options on those. The smarter traders take these speculative positions in a wise way, where they don't use a single option contract, but they use hedged option contracts and option strategies in fact to take speculative bets, which can limit the amount of loss that such speculation can have. So I think speculative sort of directional trades are one part. Secondly, like I said, the smarter guys are doing spread trading. So instead of taking naked puts or naked calls, what they do is they take hedged positions. For example, they'll buy spreads or straddles, strangles, or different strategies to speculate into the market. And this is not just speculative. Sometimes people are, betting on a directional movement in the market or a particular stock. Sometimes what they believe is that this option or this particular contract is going to expire without much movement, so they will sell those option contracts and they make small amount of money on the theta value or the time decay value of that contract. Essentially, any contract that is out there in the option market has a time value. So before its expiry, it has certain value which decays as the option reaches the expiry. So many people just bet on the option losing that time value without moving a lot, and you see a lot of traders in fact betting on this option price decay and selling option contracts as a majority of these trades. Finally, you also see that many people might in fact be hedging their positions or their equity positions using these F&O contracts. So these are not speculators, especially if you have, let's say, a big equity position and you are not very sure about how that would move, you can buy a hedge on that equity position, which means that even if, let's say, my equity goes down, I am hedged, I will not lose a lot of money because my hedge would actually go up in value. So for example, I have a Nifty ETF, right, that I have bought, and let's say the Nifty corrects, then my value would go down. But on the other hand, let's say I bought a Nifty ETF and I have bought a put option in the Nifty, then while my Nifty ETF might go down, my put option would increase, my overall position would be hedged. So that is something that people do. Another big type of trading that people do is something that we call arbitrage, which is used widely in the option space. Now this has become increasingly difficult for retail traders to do. With so many algos running which are doing arbitrage, it's very difficult for a manual trader to take advantage of these opportunities. Even I would say, if you have a broking API, many high frequency algos with much sophisticated technology are actually chasing these opportunities. Now as an arbitrage, what you would do is there is the same instrument listed on two places. For example, let's say there's a futures on Reliance and there's Reliance stock. They essentially should have similar sort of values, or there should be a small spread because this future will expire after some time. But in fact, sometimes that price divergence increases a lot, and that is where arbitrager takes opposite positions and makes sure that he's capturing that big divergence because they're going to expire at the same price. So that is another type of trade that people sort of do, and arbitrage can be done in various ways. They can be done between cash and futures, they can be done between index and its components, they can be done between NSE and BSE, or they can be done using a synthetic futures contract and a real futures contract, and a number of different ways. People also do statistical arbitrage. What that means is that they're not hedging the exact same instrument, but let's say they are hedging HDFC bank with the ICICI bank, or they're taking some sort of statistical trade where they see some opportunity and they're trying to sort of hedge it. So I myself have worked widely in the F&O trading space in my career. I used to work on creating these arbitrage algorithms, cash futures, index arbitrage, even algorithms for cash trading for years and years before I started Right Research. And now algorithms have become extremely common. In fact, many of our investors, given my background in algo trading, come and ask, what sort of algos you can run for us. So let's quickly talk about the types of algos that retail traders can in fact use. The first type of algos that are very widely used are trend following algorithms. You come up with an indicator that gives you a sense about a trend that is forming either in the upward direction or the downward direction, and you just participate in that trend. If you're smart about it, then you also make sure that you're hedged in your trend following so that you're not taking excessive risk when you're chasing these trends. But a lot of people actually do trend following through different trading algorithms in the intraday basis, or maybe they take positional trades for a few days as well. Second type of trading that people do is in fact mean reverting. Mean reversion, what that means is that you expect certain patterns to revert to their means, right? For example, people expect valuations to revert to their historical means, or let's say the divergence between two contracts we talked about, let's say Nifty and Bank Nifty, their ratio to revert to a mean in the long term, right? So that is the type of bets people take, and then you can do different types of mean reversion. Third type of trading is the arbitrage algorithms. Like I said, arbitrage, doing it manually is impossible in today's world. More than a decade ago, arbitrage used to be done through manual traders, but now with the excessive volume and excessive algo trading that is there, arbitrage can only be done through algos. And in fact, most of the algo trading volume that is going out in the market is doing arbitrage between cash and futures, index options, or different option contracts, futures, different variations of these. Finally, like I said, a lot of trading happens on expiry day. Around the expiry, people do a lot of speculative sort of trades because there's a lot of fast theta decay that happens on that day. So there is a lot of movement that happens in the market around that time. A lot of options are expiring, people are rolling over their positions. So obviously algorithms are a very interesting part of F&O trading. It excites me as well as a lot of retail traders on what we can do with these. But algorithms are also influencing how trading volumes and how trading profits are varying. On the other hand, there are many advantages of algos as well, right? As a retail investor, instead of taking speculative bets, you can define your trading strategy as well-defined rules, put it into a system and make sure you're taking wiser decisions and more consistent, objective decisions, unbiased by your emotions. There are certain best practices that we should use before we dabble in this. See, first thing you have to do is obviously have a comprehensive education of this space. Understand the type of contracts, understand the type of, let's say, option strategies that you can work with. What are the risk rewards when you take a naked call in an option versus a hedged call if you're taking it, so that you know how you can safeguard your capital as well. Second thing you have to understand is the risk management. We talked about the option strategies or the hedged contracts that you can work with instead of taking naked positions, so that you are hedged in your risk also. You should understand stop losses, you should understand take profit strategies if you are actually trading options. Terms like theta, vega, delta, etc. mean in the market. Whenever you're taking a speculative bet, make sure that it is not more than 2 to 5% of your capital, right? Otherwise, something goes wrong, you would risk to lose all of your capital because of one speculative trade. If you are taking positions, then make sure you are diversifying it across the board. That is even valid for algo trading. I have seen certain retail algo traders who in fact work with more than 20-30 signals, therefore come up with a less risky strategy. If you are doing F&O trading, it requires you to do close monitoring. So if you're doing it along with your job, I don't think that's a good idea. You have to be present and watch that position on a terminal or have a system that is monitoring and giving you alerts. You also have to be aware about the macroeconomic events that can happen and impact your position. You have to be aware of the regulatory scenario, and you should be aware about the changing market trends as well. And you should know what are the things to monitor. For example, the FII flows, the put call ratios, and finally you need discipline. You should not rely on only one signal but combine multiple indicators to come up with a signal. If you have the skill set, you should work with a system instead of taking manual calls, and it can prevent you from impulsive trades and large losses. That was our quick overview on F&O trading. If you are interested in F&O trading, please do write in the comments what are the strategies that you work with and what other topics in F&O you would like us to talk about. If you like this video, hit the like button, share it with your friends and subscribe to our channel. We'll see you again next time. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.